Sales of new homes rose in April, the second straight month of growth for a record low. But my next guest says we still have some problems that could be with us at least for the next couple of years. Joining us now is Hugh Johnson, chief economist at Hugh Johnson Advisors. Based on data compiled by Bloomberg, he is one of the most accurate forecasters of the U.S. economy, and we call him a Bloomberg best. He joins us from Albany. Hugh, welcome to Bottom Line. Thanks so much for joining us.
Nice to be with you, Mark.
Those numbers, they were better than expected, but what else should we read into this?
Well, I'm not sure you should read too much into it. It's better than expected, and that's always good news. It's, first of all, these are hard numbers to forecast, so the fact that we are better than expected is not that significant. I think that if you look at the numbers, look at the sales of new homes back to, say, last April, and you put it up in a chart, I think what you'll see is that we're kind of bumping along the bottom. So, yes, some months are good, some months are not so good, but basically we're not making a lot of progress, and I wouldn't really call this a recovery in housing, and not yet anyway.
Then what would you call it?
Well, I'd say it's bumping along the bottom. I know a lot of folks would like to say it's a double dip, that housing is going back into a recession. I wouldn't call it that. I think we're looking for some footing, and then quite frankly, Mark, until we start to remove some of the inventory of unsold homes on the existing home market, and there's a lot of inventory as a result of foreclosures and pending foreclosures. Until we get those inventory levels down, eliminate that overhang, I don't think you're going to see housing starts recover and sales of new homes recover. It's going to take, basically, the missing piece of the puzzle is time.
And Hugh, we also have that shadow inventory that's also having a problem here. How do we work through all of this?
The problem is, as I say, it takes a lot of time. You know, affordability is pretty good. We're seeing that houses are affordable because of the combination of prices and a little bit of growth in income. But that's going to take a lot of time. We've got to work through not only the existing inventory that we read about, but as you mentioned, the shadow inventory. You know, a lot of houses, a lot of folks are 90 days overdue in paying their mortgages. A lot of that stuff's going to come on the market and it's going to need to be sold by financial institutions. We can sell all that. We can work through that inventory, but the problem is time. It's going to take time. It would be nice. It'd be really nice to see some improvement in the unemployment rate, see that come down, see income start to gather some steam. We'd see this recovery a little bit further along. But all of that's going to happen, but it takes time and therefore a lot of patience.
You then talk to me, how much about this lingering fear that prices are going to continue to fall? How does that affect the psychology of all of this?
Well, the psychology it's a big part of it because, as we know, houses are about 30%, a little less now, 25% of the assets that are held by households. So when you start to see some downward pressure on prices, and it really doesn't have to be downward pressure on prices, prices could be very flat, as I expect they will be right through 2012. That's not good for consumer confidence. And when you start to hurt consumer confidence, you start to hurt consumer spending. And that's a much more important part of the U.S. economy. That's, of course, 70%. So housing may seem to be insignificant and something that might even be called trivial, but it's not trivial because it affects confidence and affects spending.
And Hugh, this is a buyer's market, but tell us about the competition between new home construction and foreclosures. Builders won't increase inventories with all these foreclosures on the books.
Absolutely. With the foreclosures on the books, that's obviously a detriment to any builder going out and starting to build. You'll see that in the Toll Brothers numbers. You'll see that in the numbers of just about every home builder. They're not very optimistic. They don't see anything changing anytime soon. And the problem is they know, as you know and as I know, there's this inventory of unsold homes or foreclosures that still has to be worked through.
And you talked to me about the backlog in state courts. Is that a factor in all of this? Is that slowing things down even more?
Of course. The whole process is very slow. If you take a look at the banking community and the whole process of moving foreclosures through the banking community, the problems in the courts, all of that being held up, that once again means that it's going to take time and patience to work through all of the foreclosures or all of the unsold homes that need to be sold.
Hugh, if I might ask you then in our last 90 seconds, one of the factors that also comes in, you talked about the unemployment rate, a lot of people losing their jobs, a lot of people who have jobs. As you mentioned, that fear in the market that affects the psychology, they're holding on to their money, hoping that prices are going to drop even more. And then there's that credit, which is still tight. With I guess guidelines for credit even tighter than they have been, what's a potential buyer to do? They could have had good credit before, and then they took a hit because they lost their job. Their credit score is now way below what it was before. What are they to do?
Once again, it's going to take time. I urge everybody patience. You're absolutely right. It's credit conditions. It's not just that the unemployment rate is high, and that's obviously bad for housing, but also credit conditions. If you take a look at the lending numbers for major commercial banks, C&I loans might have been expanding a little bit, but really across the board in just about every category, and you include residential mortgages, we're seeing year-over-year declines or a contraction in lending. So the combination of high unemployment, no appetite by financial institutions to make loans in general, and certainly no appetite to make a lot of loans in the residential mortgage area.
And you, if I might ask you in our last 15 seconds, then a lot more multifamily dwellings we're going to see?
Yeah, you're going to see a lot
of renters, right?
You bet. A lot of renters, because obviously it's very difficult to be able to buy a home when credit conditions and the unemployment rate, but credit conditions are what they are.
Hugh Johnson, Chief Economist at Hugh Johnson Advisors, joining us from Albany. Always a pleasure. Thanks so much.